That's right. Certainly, the banks have been pretty clear that as the situation's deteriorated over the past fortnight, then you should expect pretty high provisions again in Q2. I wouldn't be surprised if we saw the same again in Q2. As we move into the second half of the year, it will look slightly differently, though. We think the provisions will stay quite high, but a bit of a mix shift there between the charge-offs, which you should start to see coming through in terms of the default rates and the subsequent charge-offs, and probably slightly lower reserve builds. But we would expect to see some reserve builds. It really depends how quickly the US can get back to work, and obviously, you've got to balance the back to work with the health and safety of the people within the economy. So that's a very difficult balancing act for the US and for all global economies.
John, setting aside the provisioning, I was actually quite impressed with some of the numbers that we saw delivered by the likes of Goldman Sachs around the markets businesses and obviously Citi in terms of just general overall business activity. My question would be to you, look, it's a black box in terms of what the provisioning ultimately will end up being. But are these banks in a resilient enough position now that they're actually well placed to deal with whatever comes down the pipe?
I think that's exactly it. I think if you look at what they call the pre-provision profit, then that's actually remained very strong. Certainly, the Goldman Sachs have been very strong trading numbers. And if you looked at, if you break down the divisions, 3 out of 4 of the divisions had revenue growth of over 20%. Shows you that the business is actually performing pretty well. Citigroup also, as you pointed out, had some very strong trading numbers, up over 30%. And the efficiency ratio actually dropped down to 51%, which is good news. So you're generating a lot of earnings, and then you have the high provisions on top of that. I think that the key thing that the banks are looking at here is they're generating enough earnings to cover the dividends. Now, I don't think investors should expect much in the way of buybacks as we go through the rest of this year. They're cancelled until the end of Q2 anyway. I think the key thing is they are generating profit still. So you shouldn't get hits into the book value of the companies as we move through. Now, obviously, that can deteriorate. The economy can deteriorate a little bit, and they might have to take higher provisions. But at least the US banks are generating some very good pre-provision numbers, and that should be more than enough to tide them through the increased provisions.
So very briefly, if I could just get you to bingo call, who do you like? Who would you own in the space at the moment?
Well, I think the methods banks are faring pretty well. We actually like Citigroup. They're most exposed on the credit card side, but from a valuation perspective, they are trading at 0.6 times tangible book value, and that implies that people are expecting them to generate absolute losses and hit into their capital. We don't think that'll happen, and therefore at those sort of discounts, we think they're very well placed. And we also we also like Morgan Stanley. They're reporting later on today, as you mentioned. We think the trading numbers there will be very good too. The wealth management business like to hold up. They will take higher provisions, but again, trading at slight discount to book, we think that business is very well placed as you come out of this crisis.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.